Hello everyone and welcome to the Gold Edge Academy. If you're new here, thank you for stopping by. This channel is dedicated to helping traders understand the market in simple, practical way. Whether you're a beginner or someone who's been trading for so many years, my goal is to help you see the market in a different way and improve your trading and market making decisions. Today we are starting with one of the most important topics in trading, which many traders often ignore: market structure. Now, here's something a lot of traders don't realize. A lot of people are using the market structure incorrectly. They simply connect random highs and lows, label every move as a break of structure or even change of character, and expect the market to move in their favor. Unfortunately, that's not how professional traders approach it. The truth is that market structure isn't just a way of drawing your charts. It's a framework that helps you understand who is in control of the market, whether it's buyers or sellers. When you understand it properly, it becomes a foundation of every trading decision that you make. Through this series, I'll show you how to use market structure as a complete trading strategy instead of treating it as just another concept. As intraday traders, we need direction before we look for entries. That's why we'll use the 1 hour and 30 minute time frame to determine our market bias. These higher time frames help us understand whether we should be looking for buying opportunities or even selling opportunities before dropping into lower time frames for executions. Once we know our bias, everything becomes much clearer. We stop fighting the market, we become more patient. When you only take trades that align with the overall market direction. In our lessons ahead, you'll learn how to correctly identify bullish and bearish market structures, recognize genuine breaks in structure, avoid common mistakes, and use market structure together with liquidity to find high probability trading opportunities. If you're serious about becoming a consistent trader, then you're in the right place. Let's get started and build a solid understanding of market structure from ground up. As you can see in front of our chart, we have a scenario of a bearish change of character, from a bullish to a bearish change of character. Previously, the market was moving in a bullish direction, and as you can see right here, we have a break of structure right here. After a break of structure, now for us to change our character, remember this is the 30 minutes time frame. Let me indicate it right here. 30 minutes time frame. Serious about becoming a consistent trader, then you're in the right place. Let's get started and build a solid understanding of market structure from ground up. As you can see in front of our chart, we have a scenario of a bearish change of character, from a bullish to a bearish change of character. Previously, the market was moving in a bullish direction, and as you can see right here, we have a break of structure right here. After a break of structure, now for us to change our character, remember this is the 30 minutes time frame. Let me indicate it right here. 30 minutes time frame. Sorry. Now we are in a 30 minutes time frame. When we break this structure, for us to change our character, we need to break this low right here. Remember, these are our higher highs, these are our higher lows right here. So for us to break this structure, for us to move into a bearish scenario, we need to break this low right here. And as you can see in front of us, that's what we exactly did. We broke this low right here, and after breaking this low right here, you can see our retracement into this zone. Now what you need to do, just take your Fibonacci retracement from this high up here, this low right here, and wait for a retracement into either the 0.5 or the 0.76 or the 0.618 retracement in your Fibonacci. I'll show you how to use the Fibonacci retracement tool in our charts. Now this is a bearish scenario. Let's go and look at a bullish scenarios. Let's draw a bullish scenario. Now for a bullish scenario, we'll use the same concept, the very easy concept. Don't worry, I will show you in our charts. We'll go to our charts right away. Don't worry, I'll show you in our charts. Okay, now let's draw a bullish scenario. We had a bearish trend right there. Okay, let's delete this one. Hit a bearish trend right there. Come, break the structure, take out that high, retrace back, and go up higher, forming higher highs and higher lows. Let's get that out. Okay, now this is our structure right here, from bearish to bullish. You have a change of character right there. Remember, we have to for us to change the character, we have to break this structure right here. That's what we need to indicate here, that we broke this structure. So after breaking this structure, we need to take out this high that broke the structure. This high that broke the structure, we need to take it for us to have a change in character. Let's indicate that's our change. Change in character. You don't have to complicate anything. Break of structure right there. And after that, we draw our Fibonacci. We take our tool, Fibonacci tool, from this zone. From this zone all the way to this zone. Wait for the market to retrace back. For example, let's say this is 0.5 and this one 0.76. Yeah, we wait for the market to retrace into those areas. Now let's go and look at a real market scenario. Now this where you apply everything into a trading view. Okay, now we have this type of a scenario right here. As you can see, recently we are in our 30 minutes time frame, and as you can see, we draw a path. We are forming higher highs, lower highs and lower lows here, as you can see, yeah, right there. So after that, we can see that our market was previously in a downward move. We can see a break of structure right here. Here's our break of structure. Our break of structure right there. So what we need to do is to take this high that formed this break of structure, that broke this structure. After taking out that high, what do? We retrace back to this zone. You use the Fibonacci tool from this zone, drag it all the way you can extend it up to that area. Now after that, you can now go back to your normal candlestick chart and look at that entry, very precise, just by using the market structure, the 30 minutes time frame. Very precise entry. Obviously we take our trade either from this trade zone 0.5, 0.68 and or the 0.676, but I recommend the 0.76 because it's the optimum trade entry. It's where market makers take their entries. Okay, the 0.75 0.7686 zone. You can see, like, you can check other confirmation. Like here we have an order block, a bullish order block right here. Yeah, it's a valid order block because it's the order block that broke. It's a order block that took out this high. So we can easily take our trade from there and target. You can target this high and look at that. The trade laid out very well. We can look at another examples, and I can look at another bullish example and another bearish example. Okay, let's see this one. First, you use your line charts. You change the nini to line to become to your line charts. Yeah. Let's look at an example. For example, let's look at this one. Line chart. Okay. We can see we have a break of structure right here. We were previously in a downtrend. Obviously, the market was pushing downwards. You can see I'll change a break of structure right here. Sorry. Okay. We have a break of structure right there. After that break of structure, now we know that we need to take this high for us to change character. This high, we need to take that high for us to change our character. After that, take your Fibonacci retracement tool from there up to there. This strategy always works like magic. Go to candles, and what do we do? Wait for the market to retrace back either to the 0.76 or the 0.618 or the 0.5 retracement areas. Take your longs from that zone. For example, like here, let me see. We would have taken our longs from this zone. Yeah, from this low. Yeah, from this zone. Target this high, this liquidity zone here is too high. It's like right there, this liquidity zone. Yeah, that's our target. And look at that trade. Our stop loss just below these lows, and look at that, how our trade played out very nicely. This strategy works like magic. You can now look at a bearish scenario like right here. That lower time frame, the 5 minutes time frame. Let us look for another example right here. A bullish example. A bearish example. As you can see right here, we were in an uptrend. There's an uptrend. Okay, we were in an uptrend. Although it is not a big uptrend, it's a small uptrend, but it's still an uptrend. Yeah, Okay, after that we go to our line chart. You can see right here we have a break of structure right here. Sorry, we have a break of structure right there. So what we know is that we need to break this low where the break of structure originated from, so that we can change the character. So after that, what do we do? In this case, we'll take our Fibonacci retracement from this low. So from this low to this to this other low. Okay, and wait for a retracement into our zones. Is either the 0.618 or 0.786 or the 0.5 zones. And look at that. Take our shot and our shot from here, from that zone to the next target, this liquidity area right here, this area right here, this low. So our target, and our stop loss just above this high, just above that high, and boom, look at that. Look at that trade. Let us look for another for the last example. That one we have to look at. Let's look for a different example for a last bullish example. Very easy. Just make trading as easy as possible. Okay, let's take this one. So our last example, as you can see, we have a break of structure right here. The market was previously bearish. Just first identify the market bias. Where was the market previously going? Bearish, obviously. We look at our last break of structure, a very easy strategy. Our last break of structure is that one. We need to break this low, this high, sorry, so that we can change character. So as you can see, we broke it here. Now take your Fibonacci retracement tool. It doesn't necessarily have to be the Fibonacci retracement tool, because you can use other concepts. You can use liquidity, you can use candles for confirmation, you can use pin bars, you can use fair value gaps, order blocks. It doesn't have to be the Fibonacci retracement, but it's also a good confirmation. So after that, we change into candles. Let's see if we have a retracement into this area. As you can see, we didn't have a full retracement to this area, but what do we have? We have an order block right here, an order block. And how do you know this is a valid order block? Because this push upwards broke out this switch that broke this structure, this formed this change of character. We can see have another block right there, and this is where we should have taken our longs. Take your long from this zone. Take your long from this zone to cut that high. You can target that high, this liquidity area here. Right here comes our target. Yeah, like that. A very beautiful trade, very beautiful. Our stop loss just below this this zone, this order block zone, and look at that. A very nice trade. Okay, let's look at our last example. Okay, let's see, where did this originate from? Okay, we can take this one, convert to first change. What do? We first change into line chart. Okay, we were previously in an uptrend. This was previously an uptrend. Okay, this move is from here. Sorry. Okay, this move is from this zone right here. You can see we were previously in an uptrend. Then we came to no. We came. We formed a little downtrend here. Then no, that's not a good example. Let's see if we have a good example. Another good example. Let's look at this one. Yeah, so this is a good one. Okay, we have that breakout structure right there. Yeah, we have this low. So this low, we take this low as our change of character. Is where we'll target. Is where we target. When the market breaks that one, we know that we have a change of character. From that we take our Fibonacci retracement from that from this zone. From this high to this zone of ours here, and wait for the market either to retrace to the 0.5 or anything, or an order block or anything. Go to our line charts, to our candlestick charts, and see what the market did. Retraced back into this zone. What do we have here? You can look. We have an inverted order block. Is it called an inverted or a breaker block or whatever? You have a breaker block. You can, if the market retraces to the 0.5 or the 0.618 or the 0.786, it would have even been a better entry. But here we have a breaker. Is it called a breaker block? A breaker block. So we take our entry either from that zone to that. Take our entry from here, our shots from that zone. Target this liquidity area here, this low, and target that low. Though this is the not a very nice entry, but it's still laid out very nicely. Yeah, and that will be the end of our today's tutorial or today's lesson, market structure. I hope that you learned more, or you you already something into your trading journal. Market structure, know how to use market structure, and imply this kind of mechanisms or strategies into your trading journey, and see, backtest, do testing, but I promise you, if you use this strategy, you'll eventually be a successful trader. It's just an addition into your trading journal. What strategy you are using, you can add this strategy into it, and you'll see better results, consistency, build up your consistency and everything. Yeah. It's a Gold Edge Academy here. See you in the next video. Thank you for watching.